The March 2025 bond auction of the FXD1 2018-2025 just concluded and the results are out. This bond has generally attracted a discount on the issue based on two main factors. The first important one was the duration or the maturity period of this bond, which has a balance of 18.3 years, which is the period for which the new investors are investing in this particular bond. Then the second factor was the market yield of the accepted bids, which went way in excess of the market interest rates, and also the coupon rate for this bond. So those two factors gave us a discount on this issue, as we shall be looking at the figures in a few seconds. But the most important aspect is that this is a bond that has given you an opportunity to lock your returns in higher paying instruments when the market interest rates are falling, because this drastic fall in the market interest rate is expected to continue for some time, and it will affect our existing investment vehicles that do vary in response to the market interest rates. The first thing was on the coupon payment months, which was June and December for this bond. And those 2 months are rare to get if you are looking for instruments for purposes of laddering, when you are purchasing a minimum of about 6 bonds that are supposed to give you a monthly income out of their coupon payments, on the fact that bonds do pay their coupons 2 times in a year, and therefore you get bonds that pay the 2 months, and you keep on looking for other bonds that will cover up for the remaining months to make 12 months, summing up to a year, which will guarantee you a consistent income or cash flow out of the coupons on a monthly basis. Most of the bonds that we have been getting 2024 and in the early 2025 have been paying majorly in March and September. We have had others that were paying in April and October, then November and May, but we didn't have one that was paying in June and December. So for those who are looking for a bond for purposes of laddering, this bond was a good investment. And here are the specific results out of this auction as per this schedule. A notable important item out of this schedule is that the government was targeting to collect or get a total of 25 billion Kenya shillings out of this auction, and considering the total bids that were received, they amounted to excess of 47 billion, which is almost double the amount that government was looking for, falling short of 3 billion. And that figure gave us an oversubscription of 188%. Out of that oversubscription, the government has to manage the cost of capital out of this debt acquisition, and therefore, in its effort to manage the bond or the bids, so many bids were rejected both in the competitive and non-competitive categories as based on the outcome, and therefore the accepted bid amounted to slightly excess of 35 billion, which is 10 billion in excess of what the government was looking for of 25 billion, and that was spread out as slightly excess of 26 billion from the competitive bonds and slightly above 8 billion for the non-competitive bids. One important thing to note again is that the fund managers have come out largely to look for these instruments that are going to lock some good returns compared to the market interest rate, and it's notable that they have oversubscribed a lot from the competitive bidding, and therefore it's also a call to you as a DY investor. As a retail investor, you should be looking for these good opportunities that give you averagely higher returns compared to what you are getting from your parking investment vehicle, and that is potentially the fixed income fund and the money market funds. Don't forget that your emergency funds are best suited in the money market fund or in the fixed income fund given by the same fund manager, because mostly those two investment vehicles will always have the same features. If you are going to transfer your emergency funds to this kind of investments, then you are preparing for a rude shock in the event you are faced by a catastrophe or an emergency that would require your quick response. Because investments in bonds, both fixed income bonds, both the FXDs and infrastructure bonds, are not easy to liquidate, and especially when your investment is below 50 billion, because when you are to choose to liquidate that instrument in the secondary market, it is regarded as an odd sell, which is rarely attractive, hardly attractive to the main investors in the secondary market. Those are the fund managers, and therefore that is what makes it difficult to liquidate your bond as a DIY. And therefore, the second option that you have will be discounting the same with the CBK, which does give you a loss of at least 3% of what you'll be looking for, because the rediscounting by central bank is higher at 3% of the market coupon rate or the market yield, whichever is higher. The market weighted average yield of the total bids, the excess of 47 billion that was received, stood at 13.9384. And when the rejections were considered, the weighted average of the accepted bids stood at 13.8033. Comparing that weighted average score or yield of the accepted bids with the market yield and the coupon rate for this bond, which stood at 13.4, that means that the investors are looking for a higher return compared to the coupon rate of the bond on issue. The 13.8% yield weighted average of the accepted bids, which measure the anticipation or the kind of return that the investors are asking for competitively from this bond, being higher than the coupon rate from the bond, which cannot change, that is what necessitates a compensation of the higher yields to the coupon by issuing it at a discount. So the discounted price compensated for that higher return expected by investors to the lower coupon from this bond. And the secondary factor, how it's arrived at, is the duration of the bond. This bond has a balance of 18.3 years remaining, which is the period for which the new investors are investing into. And because of that long duration, that also adds up to the reasons why this bond has to attract a discount. One, compensation for the higher yield expected by the investors to the lower coupon from the bond, that is 13.8% to 13.4%, and the longevity of investment in this bond. Those two factors gave us a discount, and the discount price was at 97.2778 for every 100. And how do we arrive at that price? You get the price out of the auction, where the price to pay for these bids, accepted bids, was 100.3701. That price is a data price. It includes the accrued interest for the period from the last time coupon was paid on this bond, and that was December of 2024. The next coupon payment will be in June 2025, and today being March, this bond has already accrued interest from December of 2024 to March 10th, when is the due date for the payments or the value date. That period, the total accrued interest stood at 3.0923, and that, when you adjust from the price given of 100.3701, you are getting 97.2778 as the clean price from the auction. The clean price has a discount of about 2.73 or 2.73 for every 100, and we have looked at how that discount is arrived at. Lastly, as important is that this bond has been used for two purposes by the government, and that was redemptions. paying for maturing instruments. Government is authorized legally to borrow to pay maturing debts. So part of the amounts that were collected, the excess of 35 billion, 27.7 billion has been used to pay for maturing bonds. And the new debt from this bond issue stands at 7.6 billion. And that concludes the analysis for the results for this particular bond, FXD1 2018-2025. And for the successful bidders, congratulations for your purchase, and see you in our next video.